here we are. It's exactly 17 minutes after the hour, 12:17 p.m., 12/12/2011. We are in the final hour, as you know, into the closing bell, as understanding the put side of the market and the call side bid over here, 620 call and 625 put. Okay? So basically, within the value lines of a electronic script, price action script, high frequency, is you can see clearly that each one of these are 3 minutes. And you can see that we came down and we made another double diamond low here. And I told you early on in this video when we went through this whole live exercise, right here and right now, is yes, you have come down and you have tested this lower area right there at that teeny line. But look at the penny increment movement, and then look at how that bid and ask works, as you've been being taught that bid and that ask. And in order to get this, they had to sell down that bid. The most important thing is you can see the length of time going into the closing bell here. You haven't closed below the teeny line here, and you haven't closed above the teeny line up here. And each one of these teeny lines are calculated before the market opens, and each one of those teenies are 76 pennies today. And within that 76 penny range that we have mapped out ahead of time to the penny, that's how accurate we are, at 76 cents a penny. The other thing is, this is at 0.35. If it doesn't go toward 40, you can't go below that teeny line. And we talked about this getting above 40, going back toward 59. So at 36 and higher, that's how you're going to be able to take out this current reversal. Now, the length of time that we have been in is that this side of the print in the put gets leveraged up. The bid is 760 by 770. When you break down, the ask will go higher here in value, like it is at 780. And then the bids in the put will come up higher. And as you break these diamond lows and get below 622.50, you'll start getting that premium that you just witnessed right here in this 3-minute candle, again within the broader teeny range. And so they bid, pop, and buy 35s, they sell 12s, then they leverage up to 35 prints. That's how you get these. But overall, during the time frame, as of right now, is what is the difference with high frequency volume machines in the bid and the ask, and how clear that they are, and the length of time that you go in this 76 range. Each one of these are 3 minutes. Okay, so there's 15 minutes. There's 1, 2, 3, 4, 5. There's 30 minutes. And 1, 2, 3, 4. One more of these bars, it'll be a total of 45 minutes in this range right here on Google. And it's 12:20 in the afternoon. The indexes are weak, but the name remains strong. And one of two things happen is either you're breaking these lows and these diamonds that are created at that teeny line during the 45-minute price action at 76 cents up, 76 cents down. That's what the lines represent, and that's exactly what we're doing right now at 12:21. And you got to print below 623.50 to get more value to go higher in the bid, and these will rise when you sell down below there. You got to sell below the 623.01 for your put value to go higher, as it is 750 by 770. You're selling, you got to sell below 622.50. You got to print below 622.50, and this side of the market would rise. You can't keep printing right in this area. You got to print below the market like he did here at 623.10, just like he did there. You can see that bid and that ask is rising live, and you got to sell down that. You got to take out this diamond live. It's here, it's now, and you got to watch that bid and ask rise, MMT. Now, what did I tell you is you got to sell down through these diamonds. And didn't I tell you live on this video in this 45-minute process is that you need another bar in price action to really take it down, and that your values go higher here when you sell below 622.50 print. This value will go higher in value when you sell below the 622.50 print. Right now he's printing 622.60. He's printing down below that bid. Look at it there. Look at the bid and ask, and look at the values here. They go up in value when you break that teeny support at the double diamond, and the body goes down in price. And this is live in this price action right now. And this is how you break that teeny line here right now, that double diamond right now. The body must fill in down toward the bottom here in order to get you up to the 850 exit. That's what has to happen. And this was within a very long-term structure, and it's live right now. They got to print down that bid. He just printed 50 pennies. 622.42 by 76 on that bid and that ask. I got a stuck market minder at 85. The ask is 72. When you print below that bid there, see 50 by 59, that when you print below these numbers, you'll get more value here on this side of the market, and you got to close below that teeny line. And in this price structure that you see in your platform is that you must close below this teeny line, and you got to fill in that price action wick to get this to go higher in value. But you can see where the breakout started at that support level, and what these diamonds are so important is to get the body or a gap bar below these diamonds, and then the continuation and sell down through the next teeny line down here where this diamond is. There's a live diamond right here. And so there is a 3-minute counter bar. So you sell down in milliseconds, they buy that bid and ask right back up. And I can tell you right now, to get the value to go higher here, you're going to have to print through that bid here. It's 84 cents. You're going to print through it and have to print lower through the bid to get this to rise in value. Closing bell, how to monitor options, how to see why the value would go during a very lengthy teeny time. Qualifier was sliding the wick, getting below these diamonds as you are now. This is the qualifier as you are now. To get this bid price to go higher over here, it has to stay below the teeny line in order for that ask to rise and close below the teeny lines here within the overall 45-minute price range, and a narrow contraction of 76 cents from this line to that line, and from that line back down. It doesn't matter, but that's what the tape is doing. And in order for this value to go higher here, you must print through this side of the market like you are. Nope, he bid popped it back and forth. They're right in there. Look at that 9s and 10s printed. They tried to get a run going on it. That's where you got that 3-minute bar coming right back up here and now. Look at what he did. He bid popped it. See, that's 25 cents difference. That's 24 cents difference. That's how you get these electronic high frequency volume machines that are in the market. It's not human beings that's doing all of that purchasing. It's a electronic price action script that gets triggered on this side, and it leverages it up. And then when they sell down the side below there, then these go up in value. But vice versa. When they leverage up a 3-minute candle, you drop in value here. So we're going into the closing bell. It's not that bad. It's the fact that you've got to sell the bid down. And you're still in this whole consolidation period relative to the bid and ask in an option trade. But the weakness must come back right away. See, this is all millisecond, as you can see. He shot it right up there. Look at this 3-minute bar. And of course your bids will drop. But now you need a red bar that comes right back down. And that's that electronic robot right here. See how he printed 624? He bought above the marketplace and ran that right up through here. Now, we've seen that happen, and this is the biggest green bar, which is a buy bar, than a red sell bar. And it all happened within millisecond. And we're coming right back up in this 1 teeny and higher area but the lows are still holding in value. There must be a reversal bar within milliseconds that come right back down. And they bought that ask all the way up to 91 cents. And it's done here, and it's done live, and it's done now. The same invert has to happen, though, next to the bar. It can't keep going higher. It's got to sell back down through the bids. See? It's got to sell right back down through the bids, and the bids got to get over on this side of the market, and milliseconds come right back down. And this is all happening in a 76 range. And you can always do one of two things. When it comes back down, if it holds that area, you can always limit out. Okay? It's all in a 3-minute bid pop. And they're still bid popping it here live right now. And that's how that put option works during this phase in a 3-minute script. But now, if you don't have a red one to come with it, then you got to start limiting out. So if you come down in a red one, you could limit out the price. But you're right here at the low of the day based on them walking that 3-minute bar. And that's how that deleveraged this down. And the red bar must come all the way back down just like it was. And this is what happens in these moves. This very same move could have been a move below the diamonds down here that held. And it did. They created them, but they never qualified and kept another closing bar below them. So now we'll watch this time frame here in the closing bell at 12:28 p.m. in the bid and ask on how they walk the ask up in that 3-minute bar, but then they have to sell the bid down, and it has to come down in the same value, and in order for these to go up in value. Okay, and that's what they're doing in the live bid and ask, and we just watched them do that whole teeny consolidation, 3-minute bars. And this is what they do in either direction of the market. Either they bid pop it below it, or they bid pop it above it. There will never be any in between. And you can see where the put options will go when they're doing that into the closing bell at 12:29 p.m. Pacific Standard Time. The ratio is not selling down the bid, but rather buying the ask up to 27 penny mark in this 3-minute follow-through bar. So there must be a reversal for your values to climb back higher.